Before 4, you're watching Today on this Wednesday here on eNCA channel 403. My name is William, last name Lehong. Now, for Sub-Saharan African countries, it's all about the Benjamins, but in this case, it's the lack of them. Kenya, Nigeria, Ghana and Tanzania, among others, are experiencing a shortage of US dollars. This is because demand for the region's exports have declined. According to ABSA, head of global markets for corporate sales, Gerald Katsenga, this is severely impacting imports and exports. Let's discuss this further with Katsenga now. Welcome to Today, Katsenga. Why can't these countries just use their own currency and convert to dollars?
Hi, Will. Thanks for having me. I think so. You see, globally, in terms of transactions, all transactions for cross-border payments are in hard currency, which is typically in dollars. And I think the challenge we've been having now is if you look at projected or estimated GDP growth globally, it's came down last year. It was at 3.4%. It has come down to 2.8%. So when you see something like that, it means our exports out of Sub-Saharan Africa are not going anywhere, which means we're not getting the dollars that we need to make cross-border payments.
Is there a specific reason then, Gerald, sorry to cut in there, that they need the actual US dollars?
So yes, it's for you to make cross-border payments, we have to settle in dollars, which is the common trading currency across borders. But the hope for me, which is the light at the end of the tunnel, is now, on the one hand, we've seen the crisis because of the liquidity challenge, or what you call the lack of Benjamin, is now you start finding alternative solutions. We now have the African Continental Free Trade Area, and it has come with a Pan-African payment settlement and payment system. So we call that PAPS. With that, what we're now trying to do is leverage the African Continental Free Trade Area and say whenever we're making intra-regional trades, when I'm paying, importing from Kenya or exporting to Ghana, we should be able to settle in local currency. And that's the next move that we're seeing now, leveraging the African Continental Free Trade Area.
And of course, that will also bring into the conversation the inflation in those regions, locally speaking, for the citizens. Let's unpack that further and talk about what this shortage, Gerald, spells for those economies and for the continent at large, as it were.
So the shortage of dollars has led to further depreciation of the local currencies in Sub-Saharan Africa. Add on to that, because of that shortage, you now have depreciation. With depreciation, because we've got hard currency debts where sovereigns have borrowed in US dollars, which means their debt servicing costs have gone up. With high inflation, where we're importing fuel, look at the war between Russia and Ukraine, where we import fuel as a nation or as a continent. Now our import bill has gone up. Add on to that, because of the geopolitical tension in Russia and Ukraine, we import grain, we import fertilizer. All those costs have gone up, which means our dollar requirement has gone up, and that has pushed inflation higher in all these regions. So on the other hand, you also have now drying international aid because of the geopolitics of the war in Ukraine, if you like. International aid that used to come into Africa, which is dollar receipts, are now going or diverted into Ukraine. And if you like as well, we now also have a funding squeeze. We've got some idiosyncratic factors. We've had the debt restructuring program in Ghana. We also have a similar debt restructuring program in Zambia. What does that do? It puts investors at an ease position, which is what we call risk-off, where now investment that would have come into Africa is now diverted into other markets because investors are worried about what will happen to their investment with these debt restructuring programs that we're seeing in the continent.
Before I let you go, Gerald, let's talk about that. When investors are looking at these regions, let's hypothetically say the shortage is now remedied. Would that spell a return to profits for the export market?
Absolutely. I mean, so, economic cycles go in boom and we also go in troughs. And I'm very optimistic now as we look, for example, in Nigeria. Because of these crises, we've seen now the Dangote oil petroleum refinery, which was recently opened just a month ago. And if you look at that, it's going to be the biggest oil refinery in the world, producing about 650,000 barrels per day, 650,000 barrels a day. So that looks at now reducing the import bill, for example, for Nigeria, which is at roughly about 30 billion annually. And they're also looking at then exporting refined oil as opposed to just exporting crude oil. And that will generate about $10 billion in inflows into Nigeria. And that will then alleviate the hard currency shortages that you see in Nigeria. If you look at when you go, for example, into Kenya, into Ghana, they've come up with government-to-government agreements with countries in the Middle East where they will import oil based on that agreement. And again, that reduces the dollar import bill for oil, and that also reduces now the impact of the shortages of dollars in these countries. And I think similar agreements will start channeling down into other countries as they learn through from Ghana and from Kenya.
Gerald, thank you so much for that in-depth look. That was ABSA Head of Global Markets for Corporate Sales, Gerald Katsenga, chatting to us live here on Today. Now,